Let's make the transition to oil service then, because we wanted to discuss that topic a bit today. Can you just paint the overall picture on the oil service industry and maybe also add the offshore industry, because it's getting quite a big industry with the renewables adding up as well. But of course, it's a different sector, but still maybe they are in the same supply chains a bit.
Exactly. I mean, you have when you look at the oil service value chain, you have some parts. Basically, this market hasn't really been supplied with new vessels and new equipment for the last 10 years. You have had completion of equipment that was ordered before 2014, but not much new ordered the last 10 years. And this is obviously an opportunity, but then things have happened to different parts of the value chain over the last 10 years too. I mean, the companies are working much more efficient now than they did before. The drilling programs are much more just in time than they were before. So it is not evident that you need as much equipment now as you did then to produce the same oil. And then what we see is that it takes if you start with seismic. There, the problem is that you have fewer customers now than you had before, and it seems like they definitely need less seismic than they did before of some reason, and it seems to be too much spare capacity for now. It will probably come at some point, but at the moment it looks a bit stretched. Then you go to the rig industry, and what we do know is that it's very expensive to have a rig stacked. That's a nightmare to have a rig stacked. So that's sort of the issue there now, is that many drilling companies sees that it takes longer than they thought to get the utilization that gives them the possibility to reactivate rigs, and also to just get the utilization they need to make money over time, because it's very expensive to have a rig idle. So that part of the oil service sort of time value chain, I'm not super bullish on right now. I think it will come at some point. It will come, and you also need drilling rigs to drill CO2 wells. So in the future, in the 30s, probably you will be using oil rigs to create CO2 wells, which is quite interesting. Then when you come to everything that floats, sort of the subsea vessels, the supply vessels, and so forth, you can see now, and latest today, DOF Group got a contract to fix a cable from a wind farm in southern North Sea. Here it's a pressure from the wind industry and from the oil service industry. Fantastic. And also you still have a market where nothing has been built for a long time. What they say themselves, the companies, have been sort of that, okay, but the renewable industries are not really, it's not really important for us because the oil and gas sector pays a lot more. On the other side, I would call it a really nice stop loss to have these renewable companies ready to take spare capacity. So this is where I have put really my chips on the table. Then you have the FPSO part where you pump up the oil. It also looks good, but also there it's a lot of expensive refits, and it's not so easy. So again, if you look at this value chain, I mean, the floating vessels that I just talked about is where I find the best risk reward, of two reasons. One is they can work for renewables and conventional, and secondly, it's not so expensive to have many of these vessels in an idle as it is with an oil rig, for example.
That makes sense. What are the biggest, if you have decided on that topic, what are then, a couple of red flags that investors should be careful about? Is it, the depth as well and the leveraging part? Because obviously you have worked a lot with high yield, so how a balance sheet can turn into trouble in the future. Is that also something you have to be very careful on the oil service industry, how the balance sheet looks? Or if the market is fine, you will be fine regardless?
I mean, in this sector, it's very little debt right now, but there are some, you want to have debt when the tide is going up. So this is, and I would say the sweet spot here. I mean, DOF Group, where I've been part of a restructuring committee for many years, and sort of really know the bits and pieces in the company. I think it's a great company. It was just over-levered. And now they have, for the next couple of years, they pay only 6% all in for their dollar debt. I mean, their competitors would have to pay 10% for the same amount of debt, if they at all get a leverage of 60% LTV as they have today. Which means that sort of you get an extra 8% IRR on your equity just because you have cheaper leverage. And then on top of that, it's fantastic for the equity holders to own an equity where just every new contract is giving explosively higher income, and also long income, not only next year, is sort of like many years. And one can say a lot about Brazil, for example, where it takes time to get the contract in place in Brazil. But when you have the contract in place, Petrobras, they pay on time. And there are huge opportunities in Brazil for Norwegian linked shipping companies at the moment. So basically, yes. So this is kind of what you want to look for in this sector is, okay, you see, okay, where you want to be in the value chain, and you find that area, and then you start to drill down, okay, where can I get most bang for the bucks? Basically, they have zero covenants, almost, or not zero, but they have very little covenants for the next couple of years. Very cheap debt, a nice loan to value. Okay, so $1 in DOF is the same as $2.50 in a oil service company without debt. And the tide is rising.
How rude of awakening do you see it will be in offshore wind coming soon? Because it's been a lot of talk, a lot of hype, but years are going fast, So how do you, I know you have some quotes about it, but offshore wind, what's your 2 cents on that project? Maybe from a Norwegian perspective, and maybe also from a European perspective.
I think what's interesting is that if you listen to many politicians, when they say sort of, yes, the wind price is on par with other conventional sources, they forget maybe 2 things. One is that when it blows, the price of electricity is low. So the wind, the electricity produced from wind is the one with the least value, basically. And secondly, the interest rates. I mean, all these calculations are done, and all the nice folders are done with zero interest rates. And now we have 4 or 5%. So it just doesn't work, because they have a huge cost when they construct, and then they have 20-year cash flow, for example, to pay for it. And obviously, it's extremely interest rate sensitive. And when you look at the other side on, for example, DOF, where you can pay down the total enterprise value in probably in 4 years, the interest rate means a lot less. And on top of that, I mean, they only pay 6%, which on a 5.5% interest rate in the US at the moment. So that's quite good.